Most Americans don't struggle with money because they earn too little. They struggle because their financial behavior quietly works against them every single day. The biggest mistake is believing that earning more money will automatically fix financial problems. In reality, higher income often leads to higher spending, not higher wealth. This pattern is so common that many people don't start to even realize that this is happening until years have passed and nothing has changed. When income increases, lifestyle usually expands with it. A better car feels justified. A larger home seems reasonable. More dining out, newer gadgets, and upgraded vacations slowly become normal. None of these decisions feel irresponsible on their own, but together they create a cycle where money flows out as quickly as it comes in. The result is a comfortable life on the surface, but very little financial security underneath. This behavior is driven by psychology, not logic. Humans are wired to seek comfort, reward, and social approval. Spending provides instant satisfaction, while saving and investing offer delayed benefits that are harder to feel emotionally. Because of this, people often prioritize short-term pleasure over long-term stability, even when they understand the consequences intellectually. Knowing what to do is not the same as consistently doing it. Another part of the mistake is confusing appearance with progress. A high salary, a nice house, or expensive possessions can create the illusion of success, while net worth remains dangerously low. Wealth is quiet. It doesn't show itself through purchases. It grows slowly, often invisibly, through discipline and time. Many people chase the image of success instead of the reality of financial independence. The most damaging belief is thinking there will always be time later to fix things. People tell themselves they will start investing after the next raise, the next promotion, or the next bonus, but later keeps moving forward, while years slip by without meaningful progress. The habit of postponing discipline is what truly keeps people stuck. Money doesn't respond to intentions. It responds to behavior repeated consistently over time. Without changing spending habits, priorities, and decision-making patterns, no amount of income can create lasting wealth. The truth is uncomfortable, but simple. Financial outcomes are shaped less by how much you make and more by how you behave when the money arrives. Income and wealth are often treated as the same thing, but they are completely different. Income is what comes in. Wealth is what stays and grows. Many people earn good money for decades and still end up financially insecure because they never convert income into assets. A paycheck can create comfort, but only accumulated assets create stability. Without that difference being understood, people stay trapped in a cycle that looks successful on the outside and fragile on the inside. As income rises, spending usually rises with it. This happens slowly and almost invisibly. The first raise feels like progress, so a small upgrade seems harmless. Over time, those upgrades become expectations. A better car payment replaces the old one. Housing costs increase. Subscriptions multiply. Expenses expand to fill the new income, leaving little or nothing left over. The problem isn't one large reckless decision. It's a series of small, socially accepted choices that feel normal because everyone else is doing the same thing. This pattern is called lifestyle inflation, and it is one of the biggest enemies of long-term wealth. Lifestyle inflation happens when improvements in income lead to permanent increases in spending instead of increased saving or investing. Once spending becomes part of daily life, it is emotionally difficult to reverse. Comfort becomes the new baseline, and anything less feels like failure, even if it leads to better financial outcomes. The danger of lifestyle inflation is that it creates dependence on continued income. As long as the paycheck arrives, life feels fine. But the moment income slows, stops, or changes, stress appears immediately. There is no cushion, no flexibility, and no real freedom. Wealth, on the other hand, provides options. It buys time, security, and peace of mind. That is something income alone can never guarantee. The simple truth is that earning more does not make you wealthier unless behavior changes. If spending always rises to match income, financial progress remains flat. Wealth is built in the gap between what you earn and what you spend. The wider that gap and the longer it is maintained, the stronger your financial position becomes. Understanding this difference changes everything. Income pays the bills. Wealth builds the future. When people stop using raises as permission to spend more and start using them as tools to invest, lifestyle inflation loses its power. That shift, not a higher salary, is what separates those who work forever from those who gain financial independence. Most financial decisions are not made with calculators or spreadsheets. They are made with emotions. Fear, comfort, comparison, and habit play a much bigger role in money than logic ever does. This is why people often repeat the same financial mistakes, even when they know better. The issue is not a lack of information. It is the way the human mind responds to money. One of the strongest forces is the desire for comfort. Comfort feels safe, familiar, and rewarding. Spending money provides immediate relief and pleasure, while saving and investing feel restrictive in the short term. The brain naturally prefers rewards now rather than benefits later. This makes long-term financial planning emotionally difficult, even when it is logically sound. Delayed gratification goes against natural impulses, so it requires conscious effort and discipline. Social pressure also plays a major role. People constantly compare their lives to those around them. When coworkers upgrade their cars, or friends move into larger homes, it creates an unspoken expectation to keep up. No one wants to feel left behind. This comparison quietly influences spending decisions, pushing people to spend not for personal value, but for social validation. Over time, this turns money into a tool for appearance rather than security. Another psychological trap is optimism bias. Many people believe the future will somehow work itself out. They assume income will keep rising, expenses will remain manageable, and nothing major will go wrong. This belief reduces urgency and encourages procrastination. Saving and investing are pushed aside because the consequences feel distant and abstract. Unfortunately, reality rarely aligns with optimistic assumptions. Habits are the final and most powerful factor. Once a spending pattern is established, it becomes automatic. Decisions stop feeling like choices and start feeling like routine. Monthly expenses become fixed, even when they are technically optional. Breaking these habits feels uncomfortable because it requires changing identity, not just behavior. People don't just spend money differently, they have to see themselves differently. Understanding the psychology behind money explains why financial success is not evenly distributed. Those who build wealth are not necessarily smarter or luckier. They are better at managing emotions, resisting comparison, and creating systems that protect them from their own impulses. When money decisions are guided by awareness instead of emotion, financial outcomes begin to change quietly but permanently. The solution to most financial problems is not complicated, but it is uncomfortable for many people because it goes against common habits. Long-term investors think differently about money. They do not focus on looking rich or spending every increase in income. They focus on consistency, patience, and protecting their future self. This approach feels slow, but it is powerful. The first shift is deciding what enough actually means. Without a clear definition of enough, spending has no natural limit. There will always be something newer, bigger, or better to buy. Long-term thinkers set a personal standard for their lifestyle and allow their income to grow without automatically upgrading everything around them. This creates space for wealth to build quietly in the background. Another key principle is paying yourself first. Instead of saving what is left after spending, long-term investors invest before spending begins. Money is automatically directed toward investments the moment it arrives. This removes emotion from the decision and prevents short-term desires from interfering with long-term goals. What remains is used for living, not the other way around. They also understand that progress does not need to be exciting to be effective. Boring financial habits are often the most successful. Regular investing, avoiding unnecessary debt, and staying invested during market fluctuations do not feel dramatic, but over time, they produce powerful results. Wealth grows through repetition, not intensity. Patience plays a critical role. Long-term investors do not react emotionally to short-term market movements or temporary setbacks. They understand that time is their greatest advantage. Compounding rewards those who stay consistent and punishes those who constantly change direction. This calm approach reduces stress and increases the probability of success. Most importantly, long-term thinkers focus on control rather than prediction. They cannot control markets, inflation, or the economy, but they can control their savings rate, spending habits, and behavior. By focusing on what is controllable and ignoring noise, they build financial strength gradually. This mindset shift transforms money from a source of anxiety into a tool for long-term security and freedom. Wealth is not built through dramatic moments or sudden breakthroughs. It is built through small decisions repeated consistently over long periods of time. The difference between financial struggle and financial stability often comes down to daily habits that seem insignificant in the moment but compound over years. This is where real change happens. The most important step is aligning behavior with long-term goals instead of short-term comfort. This does not require extreme sacrifice or a perfect plan. It requires awareness and intention. Every financial decision either moves you closer to freedom or keeps you dependent on the next paycheck. When this perspective becomes clear, choices naturally begin to change. Another key element is time. Many people underestimate how powerful time can be when combined with consistent investing. Starting earlier, even with smaller amounts, often matters more than starting later with larger sums. Time allows compounding to work quietly in the background, turning patience into progress. Those who wait for the perfect moment often miss the most valuable years. Consistency matters more than motivation. Motivation fades, but systems remain. Automating investments, limiting unnecessary spending, and creating simple financial rules remove emotion from decision-making. This protects progress during moments of stress, excitement, or uncertainty. Stability is built when good decisions happen even on bad days. It is also important to redefine success. True financial success is not about constant upgrades or public validation. It is about control, flexibility, and peace of mind. It is the ability to make choices without being forced by money. This form of success is quiet and often invisible, but it is far more powerful than appearances. The path to financial independence is not hidden. It is often ignored because it requires patience and self-control. When behavior changes, outcomes follow. Income becomes a tool, not a trap. Spending becomes intentional, not automatic. Over time, this shift creates security, confidence, and freedom. The simple truth is that money rewards discipline, time, and consistency more than talent or luck. Financial freedom is not about how much you earn, but about how well you manage what you keep. Small, disciplined actions, repeated over time, create results that feel extraordinary in hindsight. When spending is intentional and investing is consistent, money begins to work for you instead of controlling you. The future is shaped by quiet choices made today, not by sudden changes tomorrow. Those who understand this stop chasing quick wins and start building lasting security. Wealth grows slowly, but once it takes root, it provides something income alone never can: stability, freedom, and peace of mind.